Hi, everybody. Let's just wait for 2 minutes and then we'll start with the meeting. Okay. Hi, good evening, everybody, and thank you so much for joining us today. My name is Kritika, and I am a senior process analyst from Auxiliobits. And alongside me is my teammate Harjot Singh, who is a business solutions consultant. Well, today's session is extremely practical and relevant for anyone trying to drive automation initiatives inside their companies. Honestly, most automation ideas don't fail because of the technology. Well, they fail because the business case is very weak. A lot of companies already know that automation can help them save time and reduce manual work, but leadership teams don't approve projects based on excitement. Instead, they approve projects based on numbers, risk reduction, and business outcomes. So, today, our goal is really very simple. We'll show you how to build an automation business case that leadership actually says yes to. So, by the time we reach the end of this webinar, you will understand how to calculate ROI properly, how to present automation to executives, how to avoid the mistakes that kill proposals, and how to confidently justify automation investments. This session is designed to be very interactive, practical, and immediately usable. So feel free to take notes throughout the webinar. That being said, let me first introduce who we are. Well, Auxiliobits helps finance and shared service teams cut manual work by 40 to 60%, typically within 6 to 8 weeks without replacing the ERP. Most companies today, well, they are not short of tools. They're short of process in FSG. Despite years of investment in ERPs and AP platforms, finance teams still spend immense hours on invoice handling, approvals, exceptions, while the actual analytical work gets buried. This is where Auxiliobis focuses. We build agentic process automation systems that combine artificial intelligence, robotic process automation, and intelligent orchestration, handling ambiguity, learning exceptions, and operating as a layer alongside the ERP rather than a replacement for it. Engagements typically start with accounts payable, where pain is most visible and outcomes are measurable in weeks. From there, the same approach expands across approvals, expense validation, vendor management, and financial reporting. Accounts payable is the wedge. The meaningful transformation happens when the same operating layer extends across the functions. So, for companies evolving from traditional shared service centers into global business service models, agentic automation becomes the operating layer that makes the transition viable at scale. The SSC to GBS shift isn't just about expanding scope across functions, it requires a foundation where work flows intelligently across systems, geographies, and procedures without scaling headcount. This is the foundation Auxiliary Builds has built. Companies that adopt this approach operate with shared services, teams substantially smaller than peers, not by cutting people, but by no longer needing to grow finance and operations with revenue. Auxiliobase is headquartered in the United States with delivery operations in India. We work with mid market companies and global business service companies across marketing services, manufacturing, equipment rental, financial services, insurance, and healthcare. We work with the best in class platforms, not proprietary black boxes. Our partnerships span the major RPA tech like UiPath, AI and cloud vendors like Microsoft, and all of this matters for you because it means we are picking the right tool for your environment. So now that you know a little bit about us, let's quickly walk through today's roadmap. Well, today's session is divided into 5 major sections. First, we'll discuss why most automation proposals get rejected. Then Harjot will walk you through a very practical ROI framework, the exact categories leadership actually cares about. After that, we'll do a live walkthrough of a business case example, and then we'll also discuss something which is very, very important. How you present differently to a CFO versus a CEO, since a number of proposals fail because they are presented in the wrong language. And finally, we'll also cover objection handling. Questions like we've tried robotic process automation before, artificial intelligence is risky, and we do not have IT bandwidth. In all, we'll also show you how to respond confidently. At the end, we'll also share next steps and open the floor for question and answers. So with that, I'll hand it over to Harjot to talk about one of the biggest reasons automation proposals fail. Over to you, Harjot.
Just you're on mute.
Uh,
You're not audible. You need to unmute yourself.
am I audible now? Great. Thank you so much for confirming, Kritika. So let's move to this slide, which says the three categories leadership actually cares about. Whenever leadership evaluates automation initiatives, they usually look at everything through three major business lenses. And understanding these three categories is extremely important because they determine whether your automation proposals get approved or it get rejected. Let's talk about the first category, which is the time saving. Now, this is where many organizations initially underestimate the impact of automation. People often prioritize, we saved a few hours, but leadership does not look at as an hour saved. They look at it as the operational capacity gained. Let's understand this practically. Imagine one employee spent nearly 2 to 3 hours every single day performing repetitive tasks like copying and pasting the data, validating invoices, spending follow-ups email, updating the spreadsheets, and moving informations between the systems. Now, if automation eliminates even a portion of that manual effort, and that employee saves around 8 to 12 hours every week, so the impact becomes much bigger than it initially appears. Because now that employee can focus on high value decision making tasks, the customer interactions, problem solving, revenue generating activities, or strategic work that actually moves the business forward. And this becomes even more powerful when you scale it across the team. Let's say 20 employees saves 10 hours per week. That's already 200 productive hours saved weekly. Now, if we multiply that across 50 employees or 100 employees or even 200 employees, so suddenly you are not talking about small efficiency gains anymore. You are talking about thousands of productive hours recovered every single month. And leadership immediately understand the financial implication of that. The time in the business term directly translates into the productivity, the operational speed, the service delivery capacity, and ultimately the profit. That's why the time saving is one of the strongest pillar of automation ROI. So after that, we have the second parameter, which is error reduction. This is actually one of the most overlooked and underestimated cost in manual operations because manual processes naturally introduce inconsistency. Humans get tired, people miss fields, someone uploads the wrong document, someone enters the incorrect number, or someone may skip the approval step. And even small error creates a ripple effect across the organization. One simple mistake can lead to rework leads to delay, escalations, customer dissatisfactions, and the biggest problem in these cost using remains the hidden. So organization don't always track how much time is spent correcting the mistakes, how much approvals are repeated, how many delays happen due to the incorrect data, or how much productivity gets lost because teams are constantly resolving the issues. But over time, these hidden inefficiencies quietly compound. Now, this is where automation creates massive value. Automation brings the standardization, consistency, rule based executions, accurate validation, and reduced dependency on manual intervention. Bots don't forget step, they don't get distracted, they don't accidentally skip the validation, which means organizations can significantly reduce processes inconsistencies and improve operational reliability. Moreover, for the leadership, reliability is critical because predictable operation creates better customer experience, faster turnaround times, stronger compliance, and lower operational risks. With that, I will move to the third parameter, which is cost avoidance. And this is a very important concept to explain carefully during executive conversation. Because sometimes when people hear automation, they immediately assume it means replacing the employee and reducing the workflows. But that's not necessarily the goal. In most modern enterprises, automation is less about the layoff and more about the scalability. So, cost avoidance simply means as business volume increases, the organization does not need to proportionally increase in operational headcount. Let's take an example over here. If transaction volumes double, or let's say customer requests increase by 40%, or invoice processing demands grows rapidly, the company does not necessarily need to hire an equal large operation team. Automation absorbs that operational growth, and this becomes incredibly valuable for fast growing organizations because scaling manually is expensive. It increases the hiring cost, the training cost, management overhead, operational complexity, and long term operational expenses as well. But with automation in place, businesses can handle higher volume with far greater efficiencies. This is where true scalability happens. And scalability is one of the biggest thing leadership teams prioritize today. Every organization wants the growth, but they want sustainable growth. Now, if we combine these three areas together, we can see the overall impact, the time saving, error reduction, and cost avoidance. So we arrive at the key business formula that leaders use to evaluate automation investment. And this is extremely important to remember. Leadership does not approve projects simply because they involves the bots, the artificial intelligence, automation platforms, or advanced workflow. Technology alone does not convince the executives. What leadership truly cares about is measurable business outcomes. They want to understand what operational problems are we solving, how much efficiency are we gaining, how much risk are we reducing, how much future cost are we avoiding, or how quickly will the investment deliver values. Right, so this is the language executive understand. With this, I will quickly move to the next slide, which is why most proposals get rejected. Thank you. So now, this is honestly one of the most important slide in the entire webinar because this is where many automation initiatives actually fail. Not during the implementation or not because the technology doesn't work. But much easier during the leadership approval. Most organizations assume automations get rejected because leadership doesn't want to spend money. But in reality, budget is usually not the core issue. The real issue is that the proposal itself is incomplete, unclear, or not aligned with how executives, sorry for that, how executives business decisions. And after working with enterprises across the industries, we are consequently seeing three major reasons why automation proposals fail inside leadership discussions. With this, I would like to move to the next point. Just give me a second. Kritika, is my screen visible? Okay, just a second, please. Yeah, it's just taking few times. Mm, there we go. Yeah, I was on this slide. It's not visible till still it is not visible. Just a second. I hope it is visible now. Is it? Thank you for confirming. Let's get back to the topic. So I was talking about the perimeters. So now here the first problem is the lack of credible numbers. This is one of the biggest gap in automation proposals today. A proposal that simply says automation will improve efficiency or bot will reduce manual work is no longer convincing. Leadership teams constantly hear these statements. Executives today expect measurable business impact. They want evidence, financial clarity, and operational predictability. For example, leadership immediately starts asking questions like how many hours are actually being consumed today? How many people are involved in this process? What percentage of workflow can realistically be automated? What is the projected cost reduction? What is the implementation investment? And most importantly, how quickly can this investment recover itself? Because from leadership perspective, automation is not just a technology initiative. It is a investment decision. And even investment decision competes against other priorities inside the organization. Sometimes the automation opportunity itself is extremely valuable, but because the proposal lacks measurable business metrics, leadership cannot confidently justify approving it. That's why strong automation proposals always connect operational pains with financial impact. Instead of saying invoice processing take too much time, a strong business narrative would be the AP team spends nearly 900 hours every month manually validating the invoices, resulting in delays approval, payment risk, and rising operational cost. So one sounds operational, the other sound strategical, and leadership responds to the strategical business languages. Right, Kritika?
Right. So now the second major issue is wrong audience language. Well, this scene happens very frequently. There are technical teams that often present automation proposals with the help of architecture diagrams, workflows, integrations, APIs, bot structures, and exceptional handling logic. Technically, all of these things matter, but executives are not evaluating automation the same way delivery teams are. A CEO is not buying a workflow diagram, and a CFO is not approving an API integration. They are evaluating business outcomes. A CFO typically focuses on questions like: will this reduce operational cost? Will this improve budget predictability? Can this lessen dependency on additional hiring? Meanwhile, CEOs usually focus on growth, competitive advantage, and operational agility. Their questions are different. Can this help the business scale faster? Can this improve responsiveness? Can this create faster turnaround times without increasing headcount? Or will this improve customer experience and operational efficiency simultaneously? And this is where many automation presentations fail. Teams end up spending too much time explaining how the automation works, while leadership focuses on the business benefits. That distinction is extremely important because executives do not approve technology simply because it is innovative. They approve initiatives that clearly support business goals. Now, the third major issue is missing structure. Many automation proposals discuss opportunities but completely miss the execution strategy. Well, there is no implementation roadmap, no phase rollout plan, no governance model, and no financial timeline. And when leadership sees missing structure, the immediate assumption becomes uncertainty. Executives naturally avoid that, especially in enterprise environments where operational disruptions can directly affect customers, financial operations, compliance, or reporting timelines. Leadership wants confidence. They want to know what is happening first, what happens after deployment, and how risks will be managed, how exceptions will be handled, how teams will adapt, and how success will actually be measured. This is why the best automation proposals follow a phased approach. Instead of saying we want to automate everything, strong proposals explain that phase 1 will focus on high volume repetitive tasks, phase 2 will expand into exceptional handling, and phase 3 will introduce AI driven decision making and predictive workflows. That creates trust because structured planning reduces perceived risk. And if we step back and look at all of the three problems together, one thing becomes very, very clear. Automation proposals fail when they focus only on technology, but they end up succeeding when they connect technology with business value, financial clarity, operational outcomes, and strategic alignment. The proposals that get approved are not necessarily the most technically advanced ones. Instead, they are the ones where leadership can confidently justify, measure, and scale. With that, we'll make this discussion even more practical by looking at some actual ROI calculations and real business examples. Over to you, Harjot.
Thank you so much, Kritika. So let's walk through the cost benefit analysis and ROI calculator for a prime automation candidate. AP invoice processing. When we look at digital transformation, the biggest challenge isn't finding things to automate. It is proving the financial and operational viability before writing a single line of code. Here we are at the calculator. Now let us get started with it. What you see on the screen right now is a live dynamic model of our actual operations. It is designed to take our real world everyday pain points and translate them into hard and quantifiable data. Before we jump into the numbers, let's talk about why we are focusing on the accounts payable. In any growing organization, finance operations can quickly become a bottleneck. Invoices come in via various formats like PDFs, the scan image, the emails, and processing them manually requires a massive amount of repetitive data entry. So this calculator allows us to look at our current team size, our transaction volumes, our operational cost, and what a modern bot driven workflow looks like. Let's look at the raw input driven in this model. I will quickly move to the section 1, which is process, intake, and manual reality. The calculator contains the input fields. The team size is 8. Monthly transaction, we are assuming 4,200, and the average handling time is 14.8 minutes. So the error rate is 8.3 and the average salary is $60,000. However, please keep in mind that based on the project complexity, the bot implementation cost varies. So let us assume there is a mid complexity process and the cost of the bot is around $150,000 for the initial stage. So this is where we feed the baseline reality of our current state into the calculator. Right now, we have an overall department team size of 8 staff members, right? Out of this group, the day-to-day grinds of invoice processing directly impacts 6 people, right? On an average, this team handles 4,200 transactions every single month. So which scales up to an annual volume of around 50,400 invoices. Now look at the time complexity. The average handling time stands at 14.8 minutes per single invoice. Think about what that means in practice. A member opens an email, downloads a document, manually type the line item into the ERP system, verifies the vendor details and route it for the approval. So nearly it takes 15 minutes per transaction. because this process is highly repetitive and completely manual. So it introduces a human error rate of 8.3%. That means we are dealing with roughly 350 error every single month. Each error requires a feedback loop. Someone has to track down the discrepancies, reopen the files, fix the entry, and resubmit it, which heavily inflates our actual handling time. When you factor in a fully loaded average salary of $60,000 per year per full-time employee, this manual process becomes an incredibly expensive way to manage the data entry. But if you look at the rule-based percentage field over here, it sets at 94%. This tells us that nearly the entire process follows fixed logical rules, so making it an absolute textbook candidate for the automation. With this, I will move to the next section, which is the current state versus the automated state. So now on the left hand side, we see the true cost of our manual operations. Spending nearly 15 minutes per invoice across 50,400 invoices a year creates an aggregate annual labor cost of $480,000 dedicatedly strictly to manual processing only. Furthermore, our operational scale is completely limited by the headcount. If invoice volume doubles next month, our only option is either we hire more people or watch our processing backlogs growing. Now, look at the right column, the automation state driven by the standard RPA and intelligent document processing. So when a digital worker, or we can say a bot, takes over the extraction and data entry, so execution time drops from 14.8 minutes to 1.2 minutes per transaction. That is an incredible 92% efficiency gain in the speed, because a bot reads structured data flawlessly and does not get tired. The transaction accuracy climbs to 99.6%, meaning our monthly error pool of 350 invoices virtually evaporates down to under 0.4%. While human staffs are limited to standard working hours, bot runs 24 hours a day, 7 days a week, 365 days a year. So our capacity becomes instantly and infinitely scalable without adding a single dollar of the headcount. Right. So with this one, I will move to the next parameter, which is the CBA calculator and the ROI formula. Right. Now let's talk about the actual math. How does this calculator transform these time saving into a concrete financial business case? Let's walk through the cost benefit analysis calculation flow. By dropping our process time to 1.2 minutes, we save exactly 11,424 operational hours every year. If you divide those hours by a standard corporate work year of 2080 hours, the calculator shows we are freeing up 5.5 full-time employees worth of the capacity. If we map those 5.5 freed FTEs against our average loaded salary, which is $60,000, we find a gross annual saving of $330,000. To achieve this, we must look at the investment side. The platform calculates a year one bot implementation cost of $150,000. This covers software licensing, initial discovery, bot development, testing, develop and deployment, and so on things. So if we subtract that initial $150,000 investment from our year one gross saving of $330,000, we are left with net years one saving of $180,000. Plugging this into our standard ROI formula, net benefit divided by the automation cost, the calculator gave us an immediate year one ROI of 120%. Right? So with this one, I will move to the next section. So here, while 120% return in the first year is exceptional. The real value of automation is its compounding nature over the time. In year one, we observe the heavy upfront cost of building the solution. But look at our ongoing cost in the year that follows. The calculator projects our ongoing platform, maintaining, and the licensing cost to drop significantly to 96,000 per year. This means our net saving in the year 2 and year 3 jumps even higher. Look at the year 3 projection matrix on the screen over here. So over a standard 3-year life cycle, this single automation stream delivers a cumulative net benefit of 647,000 to our organizations, right? So for this finance leaders in the room, the most critical metrics on this dashboard is the payback period, because our monthly savings are so high relative to the implementation cost. This project achieves its break-even point in just 5 months. By 5 months, the automation has completely paid for itself, and every month after that is pure operational profit. Over 3 years, the aggregate return on the investment settles at a phenomenal 331%. With that, I would like to hand over to the Kritika for a quick walkthrough of a real case. Right? Hand over to you, Kritika. Thank you.
Okay, so now let us make this discussion practical with a real world example because this is where leadership conversations become much easier to understand. So, one of the most common areas where companies experience operational inefficiencies is invoice processing inside manufacturing companies. Almost every large manufacturing company deals with high invoice volumes, multiple vendors, ERP dependencies, approval hierarchies, and constant pressure on finance teams to process invoices quickly without making any mistakes. Now, on paper, the entire process looks very, very simple. Invoice will come in, the AP team will validate it, approvals will happen, and the final payment will be released. But operationally, there's a huge amount of hidden manual effort behind the entire scene. Before automation, the accounts payable team in a particular company was spending close to 8 hours every single week just on a manual invoice entry and validation activities. And this was not even high value strategic work. Employees were manually extracting invoice information, checking purchase order references, validating vendor details, verifying tax values, cross checking ERP entries, routing approvals through emails, and constantly following up with stakeholders. And naturally, when processes rely heavily on manual handling, operational inefficiencies start increasing rapidly. The company was experiencing coding mistakes during invoice entry. There were approval delays because invoices were moving across several departments manually. Validation cycles were inconsistent. Teams were spending ample amount of hours resolving mismatches. And as invoice volumes kept growing with business expansion, the workload on finance teams kept increasing month after month. Now, here's a very important thing. None of these problems look catastrophic. No single issue was creating a major crisis, but collectively, they were creating continuous operation friction. And this is exactly how inefficiencies quietly grow inside companies. Not through one massive failure, but through thousands of repetitive micro delays happening every single day. The finance team was constantly busy, but productivity wasn't scaling. Employees were overloaded with repetitive operational tasks instead of focusing on analysis, vendor management, and strategic finance activities. And this is where companies usually reach a turning point. Because eventually, leadership starts asking, why are operational costs increasing even though the systems already exist? Why are skilled employees spending time on repetitive administrative work? Why does process speed still depend on heavily on manual intervention? And that's exactly where automation discussion begins.
Exactly. And this is where quantification becomes critical, because leadership approval rarely happens based only on operational frustrations. Executives want measurable business impacts. So Once the organization started analyzing the process properly, the actual numbers revealed a much bigger problem. The company had nearly a 4% invoice error rate. Now, initially, 4% may not sound very alarming, but leadership does not evaluate percentage in isolation. They evaluate the scale. When an organization process thousands or sometimes hundreds of thousands of invoice annually, even a small percentage error creates a massive operational and financial impact. Think about what those errors actually creates inside the organization. Incorrect coding leads to rework, rework creates the delays, delays affect the vendor payment, and late payments impact the vendor relationship. So the manual correction consume employees hours, right? And eventually the finance team spends more time fixing problems than processing work efficiently. Now, when the organization quantify all these operational leakages together, leadership finally had visibility into the true business impact of manual processing. And that completely changed the conversation. Instead of discussing automation as a technology upgrade, the discussion shifted towards the operational efficiency, the cost optimization, scalability, and business continuity. Now, after automation was implemented, the transformation became very measurable. Manual effort dropped by more than 90%, and that's significantly because the goal of enterprise automation is not just faster execution, it's reducing human dependency on repetitive operational works. The system was now automatically extracting the invoice information, validating data against the ERP records, routing approval intelligently, identifying the exceptions, and processing standard invoices with minimal manual intervention. As a result, error rate reduced drastically. Approval cycles that previously took multiple days started happening within the same day. And this is something leadership values tremendously because process speed directly impact flow cash flow efficiencies, vendor relationships, and operational responsiveness. But one of the most important business outcome was scalability. As the organization continued growing, invoice volumes naturally increased. Normally, businesses solved this problem by hiring additional finance staff. But in this case, because automation absorbed the growing workload, the organization avoided hiring additional FTEs altogether. And this approach became a huge strategic advantage. This is because growth is no longer directly tied to proportional headcount expansion. The organization become operationally scalable because executives are not just evaluating automation capability, they are evaluating business confidence. So can this initiative create the measurable impact? Can results be tracked? Can investment recover quickly? And when the answers become measurable and structured, leadership approval becomes significantly faster.
Exactly. And this example, it also teaches us something which is very, very important. Successful automation business cases are never built around technology alone. Instead, they are built around operational pain, measurable impact, financial outcomes, and strategic scalability. Because leadership doesn't invest in bots, leadership invests in business outcomes. And now that we have understood how a real automation use case gets positioned for executive approval, let's move on to the next slide, Harjot.
Right. So here I'm going to present how we are going to pitch the CFOs and the CEOs. A CFO and a CEO evaluates differently. A CFO wants numbers, risk reduction, cash flow visibility, budget impact. So your language should focus on the payback period, the ROI, cost avoidance, and financial predictability. But if we talk about the CEOs, they think in a strategic way. They cares about the growth, the scalability, the speed, and the competitive advantage. So instead of discussing workflows, discussed faster operations, improved customer experience, business scalability, market responsiveness. And one important tip, always send two documents, a concise executive summary and a detailed appendix. Executives wants clarity first and details later. Now, let us address the objections almost every automation project faces. Hand over to you, Kritika.
Okay, so when we talk about objection handling, one of the most common objectives we hear for companies is we have tried robotic process automation before and we have failed miserably. And honestly, this concern is completely understandable. A lot of early automation initiatives struggle because the technology was very rigid. Those systems worked only when every step followed a perfectly fixed rule. The moment there was an exception, a format change, or an unexpected input, the automation broke. So when companies say automation failed for them in the past, what they usually experience was not a lack of potential. It was a limitation of the earlier generation of automation tools. But today, things have changed significantly. Modern AI driven automation is much more adaptive, context aware, and exception aware. Instead of simply following static rules, AI systems can now interpret documents, understand variations in formats, identify anomalies, and even make low risk decisions based on historical patterns. For example, if an invoice format changes slightly, older bots may completely fail. But newer AI powered systems can still identify the supplier, extract the right fields, validate the data, and continue processing with minimal disruption. So, the conversation today is no longer just about task automation. Instead, it's about building intelligent operational support systems that can continuously adapt alongside the business.
Right. And another very common objection we hear is AI is too risky. And again, this concern is valid. Whenever organization hear terms like AI, autonomous systems, or intelligent agents, the immediate fear is loss of control, compliance issue, or operational unpredictability. But the important thing to recognize is manual operations already carry significantly measurable risk. In many organizations today, critical business processes still depends heavily on people manually reviewing the emails, updating the spreadsheets, entering the data, following up for the approval, and monitoring exceptions. That introduce multiple operational risks such as delays in processing, human errors, compliance gaps, missed approvals, and lack of visibility across the workflow. So the question is not whether risk exists, the question is where is the risk better controlled and better monitored. With modern automation and AI systems, every action can be tracked, audited, logged, validated, and monitored in real time only. And most importantly, implementation does not need to happen overnight. The best approach is phased implementation. You start with low risk, repetitive processes, then gradually expand automation maturity over the time. That creates confidence internally while still delivering measurable business values early in the journey. After that, the third objection we frequently hear is we don't have enough IT bandwidth. This is actually one of the most common challenge across enterprise today. IT teams already juggle infrastructure management, security, priorities, application support, updates, integration, and transformation initiatives. So, when automation is introduced, there is often an assumption that it will create additional pressure on the IT. But modern automation programs are specifically designed to minimize that dependency. The focus today is on minimal IT involvement, phased development, and collaborative governance models. What that means is business teams, operations teams, and automation partners can handle much of the workflow configuration, process mapping, and optimization while IT remains focused primarily on the governance, the security, and the integration oversight. This significantly reduced implementation friction. And because deployments are phased, organization can start small, prove ROI quickly, and scale gradually instead of attempting a massive transformation at once. That approach makes automation much more practical, achievable, and sustainable for the enterprises of all size.
Okay, so on that note, if there's one thing we hope you take away from today's webinar is a successful automation proposal is not just about technology. It's not about using complicated technical terminology, and it's also not about presenting futuristic ideas. And it's definitely not about replacing people. A successful automation proposal is really about building trust. Trust through clarity, trust through business value, and trust through structure. Because leadership teams don't approve automation simply because it sounds innovative. They approve it when they clearly understand the expected ROI, the business impact, and the implementation approach. And that's exactly what we have tried to focus on today's session. Well, the goal was to make automation conversations more practical and business oriented rather than overly technical. And hopefully, today's discussion gives you more confidence to start building your own automation proposals, even if you do not come from a technical background. Because in reality, many successful automation initiatives are not initiated by technical teams alone. So you do not need to be an AI engineer to identify repetitive manual work. You do not just need visibility into the process and clarity around business problem. And that's where exactly transformation begins. So we would like to recommend you the next steps. Start small. Don't try to automate everything at once. Begin by identifying one process that is rule driven, time consuming, highly repetitive, and operationally painful for teams. Then document how much time you've spent, how many people are involved, where delays have happened, and where errors or bottlenecks usually occur. That alone can become the foundation of a strong automation business case. And once you have measurable visibility into the process, it becomes much easier to evaluate ROI and present the opportunity to leadership. Most importantly, focus on operational outcomes and not just technology, because automation delivers the most value while it improves speed, consistency, employee experience, and decision making across the business. So at Auxiliobits, we help companies build automation strategies that leadership teams can confidently support. We work with companies to identify high friction operational areas, quantify inefficiencies, estimate automation ROI, and prioritize initiatives based on measurable value. And most importantly, we focus on automating the manual work happening around your existing systems and not just simply replacing your ERP, CRM, or core enterprise platforms. So, if your company is currently exploring automation opportunities and you're not sure how to structure the ROI story, we'd highly recommend scheduling an ROI scoping discussion with our team. It's just a simple and a practical way to evaluate where automation can deliver the fastest impact and how to present that value effectively to the decision makers. And with that, we now open the floor for questions and answers. Please feel free to drop your questions in the chat box.
Thank you, everyone. Thank you, Kritika. Thank you so much, Virender.
Okay,
All right.
so
Mhm.
with that, thank you once again, everyone, for joining us today. We truly appreciate your time and participation, and we'll see you super soon. Thank you.
Thank you, everyone.